Well, here's a great that's a great point. That's a great question. We in the beginning stages at BMO, we couldn't buy any financials. Why couldn't we buy financials? Because they cut the dividend during TARP. They couldn't pay dividends.
They had to. Yeah.
So a couple of the only companies in the financial services sector that we could own, Ameriprise and BlackRock.
Okay.
Right? And so it took a while to get the banks going in there. And so that's the biggest part of the portfolio. Then you get a little juice in there in terms of high yield. We want to try to buy companies that do pay a higher yield, like an AT&T or Verizon, 3, 4, 5% yield. Maybe they don't have the earnings growth, but they have the yield. And then finally, where the kicker is, you try to find those companies that are either beginning to initiate a dividend or really accelerating the dividend. And oh, by the way, there's some tech stocks in there. There's Microsoft and Apple. Who would have ever thought those names would be dividend growth names, but they are.
You have some really great points about this in some of your recent research. Investing in consistent dividend growers has been a favorable long-term strategy. Increasing interest rates do not hinder returns of dividend growth strategies. That's a big misnomer I think people have. You have found that is not the case. You also point out dividend growth stocks can help mitigate losses, but also participate in market strength. So this is playing offense and defense simultaneously, which I think is sort of a lost art in the markets.